Welcome to Capital Allocation Lab Calm. Clear lessons that turn classic investing ideas into practical decisions today.
If disciplined long-term investing is your language, you're definitely in the right place. Please subscribe and like to support more educational episodes. It really does help.
So today we're doing a deep dive into something absolutely fundamental, the structures and policies behind modern investing. We're digging into Chapter 9 of The Intelligent Investor, which is Graham's essential thinking on investing in investment funds.
Right. And our mission really is to unpack why costs and behavior, more than almost anything else, end up deciding your long-term results.
Exactly. And how you, the listener, can build a future-proof fund policy.
Yeah.
One that puts you in control of what you can control.
Because, the biggest challenge often isn't picking the absolute best fund out there. It's actually setting up a policy you can stick with, especially when things get rocky, when the market's panicking.
That's the key, isn't it? So we'll start with the basics. The landscape today, open-end funds, closed-end funds, ETFs. Then we'll pivot pretty quickly to the unavoidable math of fees. It's brutal, but critical.
Absolutely. And from there, we'll establish indexing as, the sensible default. We'll talk about the really high bar for choosing active management thoughtfully.
And we'll wrap up by getting really practical, detailing that one-page policy idea and building in those crucial behavioral guardrails you need to succeed over, decades, really. Okay, let's orient ourselves. When Graham first wrote about these investment structures, things were maybe a bit simpler. But the core ideas still hold up, don't they?
They really do. The basic split he identified between two types of funds, it still largely defines our options, even with new wrappers.
So walk us through those original structures. What were they?
Okay, so Graham primarily talked about two main categories. First, you had open-end funds. Think of these as your traditional mutual funds today. The defining thing about them is that new shares are constantly created or existing shares redeemed right at the fund's net asset value, the NAV.
Usually calculated at the end of the trading day, right?
Exactly, end-of-day calculation. So the price you pay or you get is directly tied to the value of what's actually in the fund.
Makes sense. And the second type?
That was closed-end funds, or CEFs, and these are quite different. They operate more like individual public companies.
Oh, so?
Well, they raise money once through an IPO, issuing a fixed number of shares, and that's it. Those shares then trade on a stock exchange, throughout the day, just like any other stock.
Ah, so the price isn't directly tied to NAV then?
Not necessarily, no, because it's trading based on supply and demand in the market. The share price can drift.
Yay.
It might trade higher than the NAV that's a premium, or more often it can trade lower than the NAV that's a discount.
Interesting. Okay, so those are the classics. But the modern landscape has a huge player now. The ETF. Where does that fit in?
Right, the Exchange Traded Fund, or ETF. It's a critical addition. Now, ETFs do trade throughout the day like a closed-end fund, which confuses things sometimes.
Yeah, I can see that.
But functionally, particularly the big, broad market ETFs, they behave much more like open-end portfolios. They hold a basket of assets, sure, but they have this unique creation and redemption mechanism involving large institutions. Authorized participants, they're called.
Okay, that creation redemption thing sounds important. You mentioned it gives ETFs a tax advantage. Let's unpack that. How does it work, simply?
Yeah, it's actually a really key difference, especially compared to traditional mutual funds.
Yeah.
So imagine you sell shares in a standard mutual fund. To give you your cash back, the fund manager often has to sell some of the underlying stocks or bonds within the fund.
Okay.
Now, if those assets they sell have gone up in value since the fund bought them, the fund realizes a capital gain. And here's the kicker. The capital gain gets distributed, usually at year-end, to all the remaining shareholders in the fund.
Wait, even if I didn't sell any shares myself, I could still get hit with a tax bill.
Exactly. That's the tax drag. It happens because someone else's selling activity triggered gains inside the fund you still hold.
Ouch. Okay, so how do ETFs avoid that, or at least lessen it?
It's that creation-redemption process. When large investors, those authorized participants, want to redeem ETF shares, they don't usually get cash. Instead, they often receive a basket of the actual underlying securities from the ETF portfolio. Crucially, the ETF manager can hand over the shares with the lowest cost basis, the ones that would trigger the biggest capital gain if sold for cash.
Ah, so they're essentially flushing out the potential gains without having to sell them on the open market.
Precisely. It's an in-kind transfer. This lets the ETF structurally purge those low-basis shares over time, meaning it realizes far fewer taxable capital gains internally. So for an investor holding it in a taxable account, the ETF is often much more tax efficient than a comparable mutual fund.
That's a really significant structural difference, not just a minor tweak.
Not at all. It's a major advantage in taxable accounts.
And speaking of structure, let's circle back quickly to those closed-end funds. You said they're still around, and they have these unique behaviors.
They definitely do. They often employ leverage, borrowing money to invest more, which magnifies both gains and losses. They can have those persistent discounts we mentioned, and sometimes they have complex distribution policies, maybe promising a high payout even if they have to sell assets to make it.
And that volatility in the discount or premium, it moves around a lot.
Oh, absolutely, because the share price reflects market sentiment, leverage effects, everything but just the underlying NAV sometimes. The price gap can widen or narrow quite dramatically, often more violently than the actual portfolio holdings are moving. It's a high-friction environment, behaviorally and sometimes cost-wise, too.
Okay, so pulling this section together, the core takeaway seems to be that the wrapper ETF, mutual fund, CEF, it doesn't magically create better returns, does it?
No, it doesn't create alpha. What the structure does do is define the frictions, the costs, the taxes, the potential for behavioral mistakes.
So the goal for an intelligent investor is?
The goal is to choose structures that minimize those frictions. You want wrappers that won't betray you through hidden costs, tax inefficiency, or by encouraging bad decisions when markets get choppy. All right, now let's talk about the math. Because if Graham hammered home one point about all others, it was about costs. His stance was crystal clear. Costs are certain, outperformance is not.
That's a stark contrast, isn't it? You know you'll pay the fees, but you only hope for the extra performance.
Exactly. You pay those costs whether the manager turns out to be a genius or, well, completely average. It's a guaranteed subtraction.
And for the typical investor, it's not just one fee. It's often like peeling an onion, right? There are layers of friction. Let's break those down.
Yes, let's. There are typically 4 main layers working against your compounding. First up, you've got loads. These are basically one-time sales charges. You might pay them up front when you buy front-end load or sometimes when you sell back-end load.
And what do those loads actually buy you? Better management.
Almost never. They primarily pay for the distribution network, the brokers or advisors selling the fund. They don't typically correlate with better future performance for you, the investor.
Okay, so loads are layer 1. What's next?
Layer 2 is the one most people know. The expense ratio. This is the ongoing annual fee charged as a percentage of your assets in the fund. It covers management fees, administrative costs, operational expenses.
Right. That's the one you see listed prominently. But there are hidden costs, too.
Oh, yes. Layer 3 is turnover cost. This is a bit more insidious because it's not explicitly stated as a single percentage. It includes all the costs associated with the fund manager's trading activity.
Like what?
Well, brokerage commissions paid when buying or selling securities, the bid-ask spread the difference between the buying and selling price of a security, and potentially market impact costs, which happen when a large fund's trading actually pushes the price of a security against itself.
So a manager who trades a lot, they incur a lot more of these hidden costs.
Absolutely. High turnover means high friction from these trading costs. It can really add up and drag down performance, even if it's not immediately obvious in the expense ratio.
Okay, loads, expense ratio, turnover costs. Is there a fourth layer?
Yes, the fourth layer is tax drag, which we touched on earlier with mutual funds. If you're holding a fund that's not very tax efficient in a regular taxable account, the annual distributions of income and especially capital gains force you to pay taxes along the way. That's a direct reduction in the capital you have left to compound.
Wow. Okay, so when you list them all out like that, loads, expense ratio, turnover, taxes, it's quite a headwind.
It really is, and it makes a powerful case for what the default choice should be for most investors seeking long-term growth.
Which is?
Funds that are no load, have a low expense ratio, maintain low turnover, and are tax-aware or tax-efficient in their structure, like many ETFs. The goal is to get these frictions so low they practically fade into the background. You want your returns to come from the underlying assets, not get eaten away by layers of cost.
Let's make this concrete. The compounding effect of even seemingly small fee differences over time. It's enormous, right? Can we run through an example?
Yes, we absolutely must. This is where the rubber meets the road. Let's assume a reasonable long-run gross market return before any fees of 7% per year. And let's look over a typical long-term investing horizon, say 30 years.
Okay, 7% gross over 30 years. Let's compare 2 scenarios with a $10,000 initial investment.
All right, scenario 1, the low fee scenario. Imagine you invest that $10,000 in a very efficient broad market index fund. Let's say the all-in friction expense ratio, minimal turnover, cost totals just 0.10% per year.
Okay, tiny friction.
Tiny friction. So your net return after that friction is 7% minus 0.10%, which is 6.9% per year. Now you compound $10,000 at 6.9% annually for 30 years. What do you end up with? Approximately $74,017.
$74,000. Okay, that feels pretty good from 10,000.
A solid result. Now contrast that with scenario 2, the high fee scenario. Let's say you invest the same $10,000 in an actively managed fund. Maybe it has an expense ratio of 1.0%, and let's estimate perhaps conservatively another 0.5% per year in hidden turnover costs and maybe some minor tax drag. So the total friction is 1.5% per year.
Okay, 1.5% drag instead of 0.1%.
Right, so your net return is now 7% minus 1.5%, which is only 5.5% per year. You start with the same $10,000, compounded at 5.5% for 30 years, and you end up with roughly $24,177.
Wow. Okay, let's just pause there.
Yeah.
$74,070 versus $24,177.
Yeah.
That's a huge difference.
It's staggering, isn't it? The difference between the two outcomes is $49,840.
Almost $50,000 difference on a $10,000 investment just because of fees.
Just because of that extra 1.4% friction per year. And crucially, that $49,840 difference, it wasn't paid for better stocks or smarter insights or, superior molecules of return. It was paid entirely to cover the costs of higher fees and more frequent trading. It just vanished into friction.
Can you put that $50 difference into perspective? What does that really represent?
Well, think about it. $50,000 could be a substantial down payment on a house in many places. It could easily cover 4 years of tuition at a state university, maybe even a private one. It's not just an abstract number on a spreadsheet. It's tangible life goals that were potentially sacrificed to fees.
It really highlights that a seemingly small percentage difference like 1.4% isn't small at all when compounded over decades.
Not at all. In this example, that 1.4% annual difference led to roughly a 75% reduction in your potential ending wealth. 24K is about 25% of 74K. It's why Graham was so adamant. Controlling costs isn't just about being frugal, it's arguably the most critical risk management you can do for your long-term portfolio.
When you see the numbers laid out like that, it makes the argument for defaulting to a low-friction approach incredibly compelling. Almost undeniable, really. Okay, so we've established the near certainty of costs eating into returns. Now let's shift focus to the other side of the coin, performance. And maybe more importantly, the investor's own role in achieving it.
Right. Because performance isn't just about the fund manager. It's hugely influenced by investor behavior. But first, let's look at the market reality.
What's the fundamental truth about active fund performance in aggregate?
Well, think about it this way. All investors collectively own the entire market, every stock, every bond. So before costs, the average return of all invested dollars has to be the market return.
Makes sense. The average can't beat the average.
Exactly. Now, active funds, by definition, are trying to beat that average. But they incur costs to do so. Research, trading, management fees. So when you take the market return and subtract all those costs associated with active management across all active funds, the average dollar invested in active funds must mathematically earn the market return minus those costs.
So on average, active investing is a losing proposition compared to just holding the market after costs are factored in.
In aggregate, yes. That's the inescapable arithmetic. Now, this doesn't mean no active manager can ever outperform, but it means the average experience will be underperformance relative to a low-cost index.
Okay, but here's where it gets even more complicated, right?
Right.
The difference between the fund's performance and what the investor actually gets, the behavior gap.
Yes, the behavior gap.
Yeah.
This is a huge, often overlooked cost. It refers to the unfortunate tendency for investors to earn less, sometimes significantly less than the very funds they invest in.
How does that happen?
It's all about timing. We tend to chase heat. Money floods into funds after they've had a great run, usually near a performance peak. We buy high.
Driven by excitement or fear of missing out.
Precisely. Then, inevitably, that fund or strategy hits a rough patch, or its style goes out of favor. Performance dips. What do many investors do? They get scared or impatient, and they sell. They sell low.
Buy high, sell low. The classic mistake.
It's classic for a reason. Studies have shown this time and again. You might see a fund with a great reported 10-year average return, say 10%. But the research firm Morningstar, for example, calculates investor returns, which track the actual dollar-weighted experience. And that investor return might only be 6% or 7%.
So several percentage points per year are just lost to bad timing, to behavior.
Yes. That difference is the behavior gap. It shows that the fund's performance and the investor's actual realized return can be two very different things. We are often our own worst enemy.
Which leads us back to Graham's core philosophy. His recipe for success wasn't about being smarter than the market, was it?
Not primarily, no. It was much more about discipline, about outbehaving the emotional cycles of the market and, frankly, our own impulses.
And how do you outbehave the market?
By having a clear written plan before the storm hits, Graham emphasized knowing three things: what you own, how much you own of it, and critically when you change it. And that when shouldn't be based on your mood or the latest news headline, it should be driven by rule.
Pre-commitment, essentially, taking the emotional decision-making out of it during times of stress.
Exactly. So when you're looking at a fund with a fantastic track record, a star manager, you need to apply a calm, almost clinical diagnostic before you even think about buying.
What kinds of questions should you ask?
You need to dig deeper. First, attribution. Where did that great return actually come from? Was it genuine manager skill, picking unique stocks, alpha? Or was it just riding the overall market wave, beta? Maybe they were just heavily invested in a hot sector or style factor. Or was it maybe just luck from one or two big winners? You have to try and disentangle skill from luck and market exposure.
Okay, so understand the source of the returns. What else?
Second, repeatability. Is the process that generated those returns stable, understandable, and likely to persist? Or was it based on, say, a temporary market inefficiency that's now gone? Was it a strategy that only worked when the fund was small? Is the team still the same? You're looking for an enduring edge, not just a lucky streak.
And third,
And this is crucial, capacity. Can the manager's strategy still be executed effectively now that the fund is much larger, perhaps due to that very success?
the curse of size.
Precisely. A manager who excelled at finding tiny overlooked microcap stocks when they managed $50 million might find it impossible to deploy, say, $50 billion in the same way. They're forced to buy larger, more well-known companies, potentially diluting the very edge that made them successful in the first place.
So if a manager seems to be prioritizing gathering assets over protecting their investment process, that's a red flag.
It's a huge red flag. You're essentially paying high fees for past performance that might be mathematically and structurally very difficult to replicate at the fund's current size. You need to be confident the edge can survive the assets.
Okay, so given everything we've discussed, the certainty of costs, the uncertainty of outperformance, the dangers of the behavior gap, where does that leave the average investor?
It sounds like it points strongly towards a default strategy, doesn't it?
It really does. For most long-term investors, indexing should serve as the core, the default baseline of their portfolio.
Let's be clear why indexing works so well, practically speaking.
Well, it excels by focusing on the things we can reliably control. First, fees. Index funds, especially broad market ones, are incredibly cheap now. We saw the math minimizing fees is paramount.
Right. Low cost is baked in.
Second, turnover. Index funds typically have very low turnover because they're just trying to replicate the index, not actively trade stocks. Low turnover means lower hidden trading costs and usually better tax efficiency.
Got it. Fees and turnover controlled. What else? Third, diversification. By design, broad index funds give you exposure to hundreds, even thousands of securities, which dramatically reduces the risk associated with any single company blowing up.
And maybe there's a behavioral benefit too.
Absolutely. Because you're not betting on a specific manager or strategy, you're just accepting the market return. It's often easier to hold emotionally during market downturns. You're capturing the market's long-term upward trend minus minimal costs without the second guessing that comes with active management.
So indexing provides cost control, tax efficiency, diversification, and behavioral resilience. That's a powerful combination.
It is. It sets the benchmark against which any other strategy needs to be judged.
Now, does this mean there's never a place for active management?
Not necessarily. We're not saying it's impossible, but thoughtful active management should be viewed as a potential complement to a core index portfolio, not the default starting point. And it's only really justified in specific circumstances.
Like where? What kind of areas might offer a genuine edge?
Generally, you might consider active, where information is less readily available, where markets are less efficient, or perhaps where behavioral biases are particularly strong. Think maybe certain niche international markets, or deep value investing in distressed companies. Or maybe areas where the market systematically underweights patience because everyone else is focused on the next quarter.
So areas where genuine expertise and a different time frame might yield an advantage.
Might, exactly. But The hurdle is incredibly high.
What defines that high bar?
Well, first, the active fund's performance must decisively beat the comparable low-cost index fund net of all fees and after taxes. Just matching the index before fees isn't good enough. You're taking active risk for no reward.
Net, after tax, decisive outperformance. Okay, what else?
This is the part people often forget. The investor that's you must possess the behavioral fortitude, the temperament to stick with that active manager through the inevitable dry spells. Even the best managers underperform sometimes, occasionally for years if their style is out of favor. Can you truly hang on then, or will you bail at the worst time?
That's a tough question to answer honestly about oneself.
It is. And it leads to what we might call the active with an audit mindset. If you're going to add an active fund, you shouldn't do it casually.
What does that audit involve?
It means writing down, maybe just in one paragraph, your thesis for owning that specific fund. Why do you believe this manager has a sustainable edge? What risks are you taking on that are different from the index? What's the strategy's capacity limit, and is the manager respecting it?
And you mentioned the kill switch.
Yes. Crucially, what would cause you to sell this fund that isn't just short-term underperformance? What would break the thesis? Maybe the star manager leaves, maybe the strategy fundamentally changes, style drift. Maybe they blow past their capacity limits, maybe fees unexpectedly jump. You need predefined reasons to exit based on the process, not just the price.
This written thesis acts as a behavioral anchor then. It helps you evaluate the fund objectively later on.
Precisely. And it helps you avoid one of the big traps in active management, closet indexing.
Ah, right. Paying high active fees for what is essentially just the index return. How can you spot that?
You look for a combination of high fees paired with holdings that look suspiciously similar to the benchmark index. A key metric here is active share.
Active share. Explain that.
Active share measures the percentage of a fund's portfolio that differs from its benchmark index. A score of 100% means the fund holds none of the same stocks as the index. A score of 0% means it perfectly replicates the index.
So what's a good active share for a fund claiming to be active?
Well, there's debate, but generally, if you're paying active fees, you'd want to see an active share of, say, 60% or higher. Much lower than that, especially below 40% or 30% combined with high fees. That suggests the manager is hugging the benchmark, likely to avoid straying too far and risking outflows, but still charging you a premium.
So you're paying for active management, but getting index-like exposure plus high costs. The worst of both worlds.
Exactly. You should also be wary of funds where the marketing is heavy on story and narrative, but light on explaining the actual investment method and risk controls. And always check that capacity discipline. If they aren't willing to close the fund to new money to protect the strategy, that's a warning sign.
Okay, let's dedicate a bit of time specifically to closed-end funds, CDS. We touched on them earlier. They often look tempting, right? Especially when they trade at a discount to their net asset value, NAV. Feels like you're buying assets for, 90 cents on the dollar.
It absolutely looks tempting, and that's why they can be a classic behavioral trap, especially for value-oriented investors Graham might appeal to. You see that discount and think free money, margin of safety.
But it's usually not that simple.
Rarely. Remember, a CEF is a fixed pool of assets like a public company, and its shares trade on the market. That discount often exists for very good structural reasons. The market isn't usually stupid. It's pricing in certain realities about that specific CEF.
What are the common reasons for those persistent discounts?
There are typically four main drivers. First, and maybe most obviously, high fees. If a CEF holds, say, relatively simple municipal bonds, but charges an internal expense ratio of 1.5% when comparable ETFs charge 0.1%, the market will price that future fee drain into the shares. The discount reflects the present value of those excess future costs.
So the discount isn't free money. It's partly just accounting for the high future fees. Makes sense.
What's second?
Second is the use of leverage. Many CEFs, particularly bond funds, borrow money to invest more, hoping to juice the returns on their equity. While leverage can enhance gains in good times, it also significantly amplifies drawdowns in bad times. This added risk gets priced in as a discount.
Right, so you're buying the assets at a discount, but you're also inheriting the risk of that embedded leverage. Might not be a favorable trade-off.
Often it's not, especially if you weren't seeking leverage in the first place. Third driver, aggressive distribution policies. CEFs are famous for promising very high, steady income payouts, maybe 7%, 8%, sometimes even higher.
That sounds attractive to income investors. It does. But if the underlying portfolio isn't actually earning that high yield through dividends and interest, Where does the money for the distribution come from?
They have to sell assets.
Exactly. They might be forced to sell assets, potentially at inopportune times, just to maintain that promised payout. This is called return of capital, and it quietly erodes the NAV per share over time. Sophisticated investors see this happening and factor it into the price, leading to a discount.
So the high yield might be partly smoke and mirrors, just giving you your own capital back.
It can be. And the fourth driver is often poor governance. Sometimes the management team or the board of a CEF is entrenched. They might resist taking actions that would benefit shareholders and help close the discount, things like conducting a tender offer for shares at NAV, or even liquidating the fund if it's chronically underperforming or trading at a huge discount. If shareholders feel powerless, the market applies a sort of governance discount.
Okay, high fees, leverage, potentially destructive distributions, poor governance. It sounds like CEFs, despite the allure of discounts, might not fit well into a simple, low-stress plan.
For a sleep-well investment plan, honestly, the complexity, the potential for behavioral errors and chasing discounts, the embedded risks, I'd say the prudent approach for most people is simply to skip them. They add unnecessary complexity.
But if someone is determined to dabble in CEFs, what's the cautious approach?
If you absolutely must, treat them as highly speculative, special situations, not core holdings. Keep the position sizes very small. Do your homework to understand why the discount exists. Is it fees, leverage, distributions, governance, or something else? And critically, always be aware that the discount offers no real protection in a crisis. In fact, discounts often widen dramatically at the worst possible time, like during a market panic, exactly when that embedded leverage is hurting you most.
So they can compound losses when things go bad. Not exactly a margin of safety then.
Not in the way people often imagine. They are generally tools for speculation, requiring significant expertise and risk tolerance, not stable anchors for a long-term policy.
All right, we've covered structures, costs, performance realities, and the indexing default.
Yeah.
Now let's get practical about due diligence. How do you really dig in and unbundle the costs and understand what you're buying?
This is where you put on your owner's hat. Let's start with loads versus advice. We mentioned loads are sales charges. Graham's philosophy really points towards unbundling these.
What does unbundling mean here?
It means separating the cost of the investment product, the fund itself, from the cost of the financial advice or service you might receive. Ideally, you pay for advice directly and transparently, maybe a flat fee, an hourly rate, or a clear percentage of assets fee to an advisor who acts as a fiduciary.
And then you buy the actual funds.
How? And then you buy low-cost, typically no-load funds directly. If you encounter a fund with a load, you have to ask, what am I actually paying for with this charge? Is it just distribution? And more importantly, does paying this load lock me into a specific platform or advisor, making it costly or difficult to change later if I want to?
So you want flexibility and transparency. Avoid getting locked in by sales charges.
Exactly. Now let's talk expense ratios and capacity. The expense ratio isn't just a random number. It reflects a deliberate design choice by the fund manager.
How so?
Well, a simple broad market index fund should be cheap because replicating an index is largely automated and requires minimal active decision-making. That's a design choice for low cost. Conversely, a highly specialized active strategy may be investing in distressed debt in emerging markets that inherently requires deep research, travel, specialized legal expertise that will cost more to run. That's also a design choice.
So the cost should be appropriate for the complexity and the potential value add.
Precisely. The critical question isn't just, is the fee low, but is the fee reasonable for the strategy being employed? And crucially, linking back to our earlier point, does the manager's claimed edge survive growth? Does the strategy still work now that the fund is bigger?
And this is where manager integrity comes in again.
Yeah.
Right, with closing funds.
Yes. You should actively prefer managers who demonstrate integrity by being willing to close their funds to new investors when they believe additional assets would compromise their ability to execute the strategy effectively. It's a sign they prioritize existing shareholders' returns over simply growing their own fee revenue. Managers who let assets bloat indefinitely are a long-term liability.
Okay, final due diligence point, turnover. We mentioned the hidden costs. How do we assess this?
You can usually find a fund's turnover ratio in its prospectus or on financial websites. It's expressed as a percentage. A turnover of, say, 100% means the manager, on average, replaced the entire portfolio's holdings within the past year. 20% means they held onto positions for an average of 5 years.
That's a huge difference in activity level.
Yeah.
100% vs 20%.
Massive difference. Now, high turnover isn't automatically bad, but it imposes a very high hurdle. That constant trading, that hustle, has to generate enough extra return to overcome all the associated friction. The spreads paid on every trade, the commissions, the potential market impact costs.
And the taxes, if it's in a taxable account.
And absolutely the taxes. High turnover constantly forces the realization of short-term capital gains, which are typically taxed at higher rates than long-term gains. It accelerates the tax drag, turning your investment into less of a compounding machine and more of a tax-generating machine for the government. So unless there's extremely compelling evidence of skill sufficient to overcome all that friction, lower turnover is generally preferable for long-term buy-and-hold investors.
Okay, we've dissected the costs and the due diligence. Now let's talk about maximizing what you actually keep. This brings us to what you call the owner's edge, thinking carefully about tax location and manager alignment.
Right. Because beating the market or picking the best fund is meaningless if you give a huge chunk of it back in avoidable taxes, or align yourself with managers who don't prioritize your interests.
Let's start with taxes. We established that ETFs often have structural advantages over mutual funds here. How do we apply that knowledge strategically?
It boils down to understanding that taxes, location matters. Different account types have different tax rules. You have tax-advantaged accounts like traditional IRAs or 401ks where growth is tax-deferred, Roth accounts where qualified withdrawals are tax-free, and regular taxable brokerage accounts where income and realized gains are taxed annually.
So we should hold different types of investments in different types of accounts.
Ideally, yes. This is often called asset location, as distinct from asset allocation. The general principle is to hold your tax-inefficient investments in your tax-advantaged accounts.
What makes an investment tax inefficient?
Things that generate a lot of taxable income or trigger frequent capital gains. So funds with high dividend yields, actively managed funds with high turnover that realize lots of short-term gains, taxable bond funds generating regular interest payments. These are best sheltered inside an IRA, 401k, or maybe an HSA if you're using it for investment.
Okay, shelter the tax inefficient stuff. And what goes in the regular taxable brokerage accounts?
In your taxable accounts, you should generally favor your most tax-efficient investments. This is where broad market ETFs really shine due to that creation-redemption mechanism we discussed. Also, specific tax-managed mutual funds, which actively try to minimize taxable distributions, and investments that are expected to generate most of their return through long-term capital appreciation rather than income, like maybe certain growth stocks if held directly, though index ETFs capture this well too.
Making these location choices consistently over time, does it make a big difference?
It can add significantly to your after-tax returns over decades, potentially adding tens or even hundreds of thousands of dollars depending on your portfolio size and tax bracket. It's a crucial, often overlooked optimization.
Okay, beyond tax location, what about manager alignment? How do we ensure the people managing our money are actually on our side?
You look for clear signals of stewardship. Is the manager acting like a partner or just a vendor?
What are those signals?
First, do the managers invest significantly alongside their clients and their own funds? Eating their own cooking is a powerful sign of alignment. Second, do they exhibit fee restraint? Do they pass on economies of scale to investors by lowering expense ratios as assets grow? Or do fees stay stubbornly high or even creep up?
We talked about capacity, too.
Yes, that's critical. A willingness to limit or close capacity to protect the strategy's integrity is a huge green flag. It shows they prioritize performance over asset gathering. And finally, look for simple, clear mandates. Are they focused on doing one thing well, or is it overly complex financial engineering that's hard to understand? Complexity often hides costs or misalignment.
It sounds like you're looking for humility, focus, and a long-term partnership mentality.
That's exactly it. And tying this all back together, think about inflation awareness. Inflation is constantly eroding the purchasing power of your money. Every avoidable cost excess fees, high turnover friction, unnecessary taxes is a certain subtraction from the nominal return your portfolio generates. Keeping those costs minimal is essential to ensuring your capital actually grows in real, inflation-adjusted terms over the long run. You need to keep that compounding engine as unencumbered as possible. All right, this is where we bring it all home. We've absorbed the principles, the math, the pitfalls. Now let's design that forward-thinking fund policy. The goal is a gram-rooted, future-fit policy that you can literally write down on one page and keep for decades.
The power isn't in complexity, right? It's in clarity and durability, something you can actually stick to.
Exactly. Simple, robust, and actionable. Let's break down the components of this one-page policy into maybe 5 key decision areas.
Okay, component one.
First, allocation. This is your strategic foundation. Define your core portfolio mix. For most people, this will be built around a low-cost, diversified core index equity fund, maybe global or domestic, and a high-quality bond sleeve, again, likely an index fund. The key here is to set an explicit equity corridor.
What do you mean by corridor?
You define a target percentage for equity, say 60%, and then set acceptable bands around it, like maybe 53% to 67%. Or simpler, define a range, like 50% to 70% equity, with a midpoint target of 60%. This corridor reflects your risk tolerance and overall financial plan.
Got it. Define the target mix and the acceptable range. Component two.
Second, rebalance rule. This is your primary defense against emotional decision-making. You need a clear, non-negotiable rule for bringing your allocation back into line when it drifts outside your corridor. We trade gut feelings for process.
What are the common ways to trigger a rebalance?
2 main approaches. You can use a calendar basis, for example, review and rebalance back to your target every 6 months or once a year. Or, arguably more effectively, you can use percentage bands.
How do the bands work?
Using our 60% equity target with a 7 percentage point band, so 53% to 67%, you would only rebalance when the equity portion drifts outside that range.
Yeah.
If stocks surge and your equity allocation hits 68%, the rule forces you to sell some equities and buy bonds to get back towards 60%. If stocks crash and equities fall to 52%, the rule forces you to sell bonds and buy equities.
So the band approach automatically makes you buy low and sell high relative to your own target. It enforces contrarian behavior.
Precisely. The goal isn't market timing, it's returning to policy. It removes the need to guess market direction.
Okay, allocation and rebalance rule, component three.
Third, selection criteria. This governs which funds you use. Your default setting, as we've hammered home, should be maximum friction reduction. No load, low expense, low turnover funds, typically broad index ETFs or mutual funds.
And active funds.
Active funds are exceptions, not the rule. You only add them if you can genuinely articulate the edge in that written thesis we discussed earlier, and you verified the manager respects reasonable capacity limits. Keep it simple. Fewer, better choices.
Makes sense. Component four.
Fourth, tax location policy. Explicitly write down your strategy. For example, hold highest turnover, highest income funds, e.g. active funds, taxable, bond funds, primarily in tax-advantaged accounts, IRA, 401k. Hold broad market equity, ETFs, and municipal bond funds, primarily in taxable accounts. Tailor it to your situation, but write it down.
Locks in that tax efficiency principle. Okay, last component, number five.
Fifth, behavior policy. This is your emergency plan for your own emotions. First, consider writing a simple drawdown playbook. What will you do or not do if the market drops 15%, 25%? Maybe it's review cash reserves for potential rebalancing opportunity, or simply reread my policy and do nothing for 7 days.
And you mentioned a cooling off period.
Yes, institute a mandatory cooling off period, maybe 1 week, maybe even just 72 hours, before making any significant changes to your funds or allocation, especially if the impulse is driven by fear or greed. Give your rational brain time to catch up.
And how do you track if you're sticking to this?
Accountability is key. You measure process adherence quarterly. Did I follow my rebalancing rule? Did I stick to my selection criteria? Did I respect my cooling off period? You focus on the process. Only measure performance maybe annually and always against your appropriate benchmark, not against unrealistic expectations.
That one-page policy sounds powerful because it forces clarity and pre-commitment. But let's talk more about those behavioral guardrails. You mentioned if-then rules. Can you give more examples?
Yeah, think of these as writing simple software for your future self, especially your future self under stress. They trade prediction for pre-commitment. If the S&P 500 index drops 20% from its peak, then I will shift an additional 5 percentage points from my bond allocation to my equity allocation at the next scheduled rebalance point. Or immediately, depending on your rule.
That automates buying low. Another example.
If I read an article recommending a hot new fund or sector, then I will wait at least 30 days and research its costs, turnover, and fit within my existing policy before considering any action.
Building in that delay to fight the urge to chase trends. What about the cooling off period again? If I'm panicking after a big drop, what exactly does waiting 7 days achieve psychologically?
It breaks the immediacy of the fear response. Panic demands immediate action, usually selling. Forcing a delay allows the initial emotional surge to subside. It gives you time to remember why you had the policy, to reread it, to consult your plan. Often by day 7, the news that triggered the panic seems less overwhelming, or you realize it doesn't fundamentally change your long-term strategy. It helps you avoid the action bias, the feeling that you must do something, even if doing nothing is the best course.
It prevents you from making a permanent decision based on a temporary emotion.
Exactly. These rules help you sidestep the classic pitfalls Graham would undoubtedly flag today, just dressed up in modern clothes.
What are the biggest pitfalls we still fall into?
Number 1 is probably performance worship. Choosing funds based almost entirely on their recent, 12-month returns. It's rear-view mirror investing.
And the fix?
The fix. Select based on enduring factors. The investment process, the quality and alignment of the people, and the price fees. Verify their risk management. Past performance is interesting, but it's the least reliable predictor of future results.
Okay, pitfall 2?
Fee blindness. Still just shrugging off a 1% or 1.5% fee because it sounds small in a single year.
We saw the math on that one.
The fix. Internalize the compounding impact. Treat every basis point of unnecessary fees as decades of lost compounding, potentially cutting your future wealth significantly, like that 75% reduction we saw. Frame it as real money, not abstract percentages.
What else trips us up?
Complexity theater. Funds with fancy, jargon-filled names, opaque proprietary models, maybe impressive-looking white papers that essentially mask simple index-like exposure and charge high fees for the privilege.
If you can't explain it simply.
The fix. If you can't explain the strategy and its edge simply to an intelligent friend, or if it relies on a black box you just have to trust, pass. Simplicity and transparency are your allies.
And the last pitfall.
Capacity bloat. Falling for a manager who was brilliant when small, but who has diluted their edge by chasing assets and growing too large for their original strategy to work effectively.
We keep coming back to capacity.
The fix. Actively prefer managers who demonstrate capacity discipline. Look for those who have closed funds in the past or clearly state their capacity limits. It's a sign they prioritize existing investors.
So wrapping this up, the core message seems to be that your temperament, your ability to stick to your rational plan under pressure is ultimately the most important asset.
It really is. Your policy provides the map, but your behavior determines if you reach the destination. Temperament is the policy you can actually keep. That's the ultimate owner's edge.
Okay, let's crystallize some of this with a few rapid-fire Q&A points, directly actionable for listeners building their policy. Ready?
Let's just do it.
First question. Do I ever really need to buy a fund with a sales load?
Almost certainly no. In today's market, there are excellent no-load options for virtually every asset class. Remember to unbundle. Pay for advice separately and directly if you need it. Buy low-cost products. Don't weld the two together with a load.
All right. What's a fair or reasonable expense ratio to aim for?
For broad core index funds, think S&P 500, total market aggregate bond, it should be extremely low. We're talking sub 0.10%, even lower in many cases now. For active funds, it must be clearly justified by a unique process, demonstrable skill, and strict capacity discipline. Anything much over 0.50% requires a very strong written justification in your thesis. Be skeptical of high fees.
Okay. When should I actually consider selling an active fund I own, assuming the manager is fundamentally sound?
You sell when the fund violates your written thesis. That means things like the manager's stated strategy changes significantly, mandate drift, fees unexpectedly increase without justification, key members of the investment team leave, or they disregard capacity limits and let assets balloon. It should not be based solely on a period of underperformance if the thesis still holds.
Sell the process breakdown, not the price dip. Got it. Last one. What's truly the best time or method to rebalance, calendar or bands?
Honestly, the best method is the one you will actually follow consistently without hesitation or trying to second-guess it. Both calendar, for e.g. semi-annually, and bands, for example 7% from target, work well if applied systematically. Bands might be slightly more theoretically optimal as they force contrarian action, but consistency beats theoretical perfection here. Pick one and stick to it.
So let's recap that model policy structure quickly.
Okay. It starts with a core allocation, probably low-fee index equity and bonds. Define your target mix and a clear corridor or band around it, say 60-40 equity bond with a 9-7% rebalancing band. Default to low-cost, low-turnover index funds for selection. Place assets smartly based on tax location. And critically, embed those behavioral guardrails, like the cooling-off period and the written drawdown plan.
It sounds simple. Almost boring, maybe.
That's the point. The fund policy that feels boring on a good day is precisely the one you'll be able to keep on a bad day. Long-term success in investing rarely comes from excitement. Owners win through discipline, keeping low fees, using plain processes, and maintaining pre-committed behavior. Thanks for joining us today. Our aim here at Capital Allocation Lab is always to distill these timeless investing principles and make them practical for today's world.
And when it comes to funds, they really are just tools. Useful, necessary tools, but not magic bullets. Graham's enduring message, I think, is that the market constantly finds new ways to package old temptations, especially around complexity and costs.
Absolutely. Our job as investors is simply to recognize those patterns, ruthlessly control our costs, focus on your own behavior, and then let the power of compounding work over time.
If you found this deep dive useful, please do like the episode and subscribe. It genuinely helps us keep producing these educational sessions and keep them free for everyone.
Remember the owner's edge. Keep your fees tiny, keep your policies simple, and keep your behavior steady. See you next time.